In 2007, Bear Stearns was worth $20 billion. By March 2008, it was sold for $2 a share. A Wall Street institution built over 85 years, reduced to a weekend transaction. Bear wasn't small. It wasn't obscure. It was deeply embedded in global markets. Its balance sheet was loaded with mortgage-backed securities and subprime exposure, long-term assets tied to U.S. housing. Housing was deteriorating, but long-term assets don't implode in 48 hours. Funding does. Bear relied heavily on short-term repo markets. Overnight borrowing renewed each day. As long as lenders rolled those loans, the system held. Then they stopped. Liquidity didn't fade, it vanished. Hedge funds began pulling cash. Trading partners demanded more collateral. Clearing banks tightened terms. Management insisted the firm was solvent. They tapped liquidity reserves. They tried to stabilize confidence. It didn't matter. Repo funding is not secured by belief in long-term value. It is secured by immediate trust, and trust is reversible. Within days, Bear could not fund its daily operations. Without funding, it could not open Monday. The firm sought buyers. Barclays hesitated. Bank of America stepped back. The Federal Reserve stepped in, but indirectly, working through JP Morgan. A direct rescue would signal that the system itself was unstable. Policymakers feared moral hazard. They feared normalizing bailouts. So the support came with a condition: Bear would be sold. On Sunday night, JP Morgan agreed to acquire it for $2 per share, roughly $240 million, from $170 per share a year earlier. The price was not about assets, it was about time. Without liquidity at 9 a.m., Bear would enter bankruptcy. In modern finance, survival is measured in hours. Bear Stearns did not collapse because its assets disappeared. It collapsed because its funding did. And once liquidity breaks, control does not transfer, it evaporates.